G'day, and welcome back. For decades, the Australian property market has been called virtually indestructible. The idea of a crash, many say it's laughable. But while our prices climb, property bubbles are deflating globally. New Zealand's market, once thought untouchable, suffered a stunning reversal, with prices plunging up to 30% in most regions. Meanwhile, Canadian prices crashed by 150,000 Canadian dollars over 3 years, while Australian prices rose 85,000 Australian dollars. If it happened to our Commonwealth comrades, can it happen here? Analysts say, yes, a crash is conceivable. We are breaking down the critical difference between Australia and Canada and revealing the single factor that must align to send our market into freefall. In early 2022, Australia and Canada had near identically inflated median home values, around 840,000 Australian dollars. Canada's collapse was swift because their central bank ratcheted up interest rates while their government banned foreign buyers and curbed immigration. This action, coupled with rising unemployment, led to mega losses for some investors. Why did Australia avoid this fate? We have two powerful shields. First, household wealth. Most homeowners are pretty wealthy, well ahead on repayments, and have large amounts of equity. This allows Australians to keep paying their mortgage and they don't have to sell. Second, a chronic shortage of housing. Ben Phillips notes this effectively fixed level of housing supply keeps prices strong. These buffers mean any economic shock would need to be deep and long-lasting to cause a crash. The central consensus among economists is that the thing that's holding the property market together is the unemployment rate. A spike in job losses is what would likely lead to a property market correction and potentially a crash. If we saw a big blowout in the jobless rate, mortgage serviceability would become unstable, leading to more forced sales and a blowout in falling home values. But how does that spike happen? It requires a tall order combination of shocks. 1. An external economic shock. Independent economist Saul Eslake says this could be an event emanating, for example, from the United States or China, that prompts Australian unemployment to rise significantly. 2. A demand shock. This must combine continued interest rate hikes and a severe cut to the migration intake. Only a combination of these factors, a severe economic downturn leading to significant and long-term white-collar unemployment, would break the market. If those triggers align, there are safety nets. The Reserve Bank would cut interest rates significantly, and the Big Four banks would go to considerable lengths to help job-losing customers avoid foreclosure. However, the political will to curb prices is questionable, as policy is often influenced by politicians who own multiple investment properties. Crucially, localized warnings are already flashing. Nearly 1,000 Australian suburbs saw the median price of homes sold fall in the last quarter. In Sydney's Bronte, the median sales price fell 30.7%, a drop of $1,903,000. While these figures reflect the mix of properties sold, they remind us that real estate is not immune to a drop. A crash would make millions of homes more affordable, but it doesn't solve affordability if it comes alongside a severe economic downturn where people lose their income. Is a crash possible? Yes, but a correction is more realistic. It all comes down to the job market. Let me know in the comments. Do you think our job market can withstand the global pressures? Don't forget to subscribe for more deep dives.